Hey everyone, we got some big news out of Supermicro Computer and its management team. Now, while I have been bullish on Supermicro Computer stock, I have recommended the stock as a buy. I still recommend the stock as a buy. This latest development wasn't all great news. There was some downside with the upside. I think it's important to look at some of the risks in every investment we make, despite the fact that we might be bullish on an investment. It helps to look at the downside, it helps to look at the risks, and we'll look at some of those in this video, and we'll look at some of the upside factors according to the company's CFO in this video here. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so in this video, David Weigand gave some commentary about their company's latest quarterly results, and I'm going to review these and highlight what it means for Supermicro Computer investors. Starting with the company saying that next-gen AI and CPU platforms continue to drive strong levels of design wins, orders, backlogs from top-tier data centers, emerging CSPs, enterprises, and edge IoT and telco customers. So this is driving demand for its products, which revenue was up over 100% in the latest quarter, and it's coming from these categories. So it's broad-based, not just one area that's driving demand for Supermicro Computer. So I mentioned that it wasn't all great news, and one of the factors was gross margin was 15.5% in the latest quarter. That was down from 17% from the previous quarter as they continue to focus on winning strategic new designs and gaining market share. This means that the company is willing to sacrifice profit margin to access new customers, to gain market share. That means they're offering perhaps lower prices, perhaps better incentives, perhaps some promotion, perhaps increasing the length of account receivable time, all trying to make their products more attractive to prospective buyers. They are willing to do this because they want to get in with these customers and then hopefully expand, right? Drive an initial sale and then hope for recurring sales or sales in different categories to increase their revenue and then increase profit margin later on as they grow even larger. This is a decision management is making. Now, it remains to be seen if this will be an effective strategy longer term, but for now, it is driving significant revenue growth, and I'm curious as to why they're feeling they need to do this, given how strong revenue grew in the latest quarter. I feel that they have room to be more exercise more negotiating power, not give these terms, maybe increase prices. And I'll talk a little bit about why that's important as well. The CFO also saying that in the second quarter, operating expenses increased by 6% from the previous quarter and 58% year over year, driven by higher compensation expenses and headcount. So to fulfill this soaring demand, the company needed to hire. They increased the headcount, they increased compensation to attract the talent they need to fulfill this increasing demand. That's why I kind of say, what if they chose not to sacrifice margin to go after market share? Because it's not easy fulfilling this kind of growth in demand. As we saw during the pandemic, remember, there were a lot of companies that experienced this huge surge in demand because consumer behavior shifted so quickly. Many companies couldn't handle that very well. Even though it was an increase in customer demand, they just couldn't handle it very well. They didn't react very well to that increase in customer demand. That's why for the last 2 quarters, I've been giving kudos to NVIDIA management because they experienced an absolute surge in demand from AI in the last 2 to 3 quarters, and they've been handling it exceptionally well. It's not an easy thing to do. So kudos to NVIDIA. Remains to be seen if Supermicro Computer handles this surge in demand. It's only recently getting started for Supermicro Computer. Let's see how they react. And we're going to see some of the moves they've made. We've already seen that with the gross margin going after market share. We've seen that with OpEx, increasing compensation and hiring more individuals. Let's see what else they've done. So cash flow from operations was negative 595 million compared to positive 271 million during the previous quarter. You might say, well, how can cash flow have been negative given the increase in profitability, the increase in sales? Well, management says that the strong profitability and higher level of accounts payable was offset by higher inventory and accounts receivable due to build plans for Q3 and the timing of shipments for Q2. In other words, their second quarter was extremely strong, to be sure, but the company spent a lot of cash getting ready for the third quarter, building their inventory for the third quarter. Remember, when you build inventory, you spend your own cash to make that inventory, and that sits in your balance until you sell it to customers, and it still doesn't turn into cash until your customers pay you. Sometimes companies like Supermicro Computer send their product to their client and they don't get payment for a month, 2 months, 3 months. I've seen terms of 6 months where they offer very reasonable terms just to get sales, and then they let their clients pay them back over time instead of forcing them to pay them back sooner. And as you might imagine, this makes the product more attractive to purchase because the buyer has better terms, more time to pay you back, and so they're more inclined to purchase your product. So this is, again, a move coinciding with Supermicro Computer going after market share, right? Building inventory, making sure they have the product on hand to send to customers. Another move they made was to offer and raise approximately $583 million by selling 2.3 million shares of their stock, and they got an average price of $262 per share. Now, if you've seen where the stock price has gone, $495 per share as of this recording. So they sold their stock at a much lower price than where it's at today. So a bit of a missed opportunity there for Supermicro Computer. If they would have held off, they could have sold their stock and raised more money by selling the same amount of shares because they would have got a higher price per share. But again, hindsight is 2020, but just goes with the overall theme of this video that it wasn't all great news for Supermicro Computer in their latest quarter, even though it was mostly very good news for Supermicro Computer in the latest quarter. It just wasn't all great news. All right, so finally, I'll end with this final comment here from the CFO that their closing balance sheet cash position was $726 million, while bank debt was $376 million, resulting in a net cash position of $350 million. So their balance sheet is relatively strong with $726 million in cash and debt of $376 million. Although given their increase in customer demand, I feel they're going to need more cash to build inventory to serve the growing balance of customer orders and the mismatch between when they make their inventory and when they get the cash from customers for selling their inventory. So if their sales continues to increase at this rate, they're going to need some more cash to fund these inventory increases, to fund these accounts receivable, because the company is soaring in terms of revenue, 103% revenue growth year over year. This is a good problem to have sales increasing so quickly that you need to figure out how you're going to build enough inventory to meet this increasing customer demand. All right, so I hope this sheds some light, and I hope this news was informative for Supermicro Computer stock investors. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.